Okay, good morning, good evening, good afternoon, and welcome back to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman. This is day 2 of the workshop, and we will be going through a curriculum today as well as a question and answer session. I will share with you, we got a lot of questions from you, but today's questions for that question and answer session will be on the material that you watched yesterday as well as today. We will have a break after the curriculum is over, which will be about 3 hours in total. We'll take about a 30-minute break in between the curriculum and before we start the question and answer session. You can we'll give you details if we're going to need to restart the room for that or not, but otherwise I'll give you that update in a few moments. Today's itinerary, as you were sent, is going to be just one quick break, not quick, but a 15-minute break in between. There's only going to be one break today between the two sessions. A first reminder, though, that there is no recording or of any kind or distribution of any of the material. Any video or audio recording is a strict violation of your terms of attendance. And today's workshop is, of course, brought to you by Marcus Smith, who is our sponsor. We will have Scott St. Clair from Marcus Smith coming on the live trading day to go over their product and to show you some of the features of it. And Mark will also be showing you how he uses the product when we do our live trading day on Monday, November 21st. There will be a replay of today's session this evening here, 6 p.m. Eastern time, and that will include the question and answer session as well in that replay. And today, the 2022 Master Trader Program is brought to you by Mark Minervini Private Access. Today's session will start, let me just see, on page 143. And that is the low risk entry point. This first section is going to be lengthy. It is going to be the better part of an hour and 45 minutes or so. Of course, depending upon the material, we'll take that 15-minute break, and then we'll have the last section for the day, and then we'll get into the question and answers. I am organizing all the questions. Remember, just try to do it on the material that is being presented yesterday and today. Some of the questions that I did receive from you were about questions that we have not yet reviewed or discussed with you. So we will have another question and answer session on day 3, following day 3's curriculum on Saturday next week. So with that said, give me one quick moment and we'll be getting ready to get started. And looks like we are ready. So let's get started with day 2 of the Master Trader Program. Let's get back to Mark and Mark.
Okay, welcome everyone. Welcome back. 2022 Master Trader Program. I'm here with Mark Ritchie. Hello, Mark.
Hey, Mark.
We're still on workbook number 1, and we're going to just dive right in here. We're going to go to page 143. We're going to talk about timing a low risk entry point, and we're going to discuss the volatility contraction pattern, because this is something that I use. It's a characteristic, actually. It's not actually a pattern. Well, I guess you can say it's a pattern, but it's a characteristic of a pattern. Like a cup with handle would have volatility contraction characteristics. And one of the reasons why I even came up with this was simply to teach others on how to identify constructive price bases when a stock was consolidating. And so we're going to talk about this series of contractions that happen while the stock is moving sideways, and there's a reason behind it. There's a very good reason why we use it, and why we use it almost exclusively. Virtually all the buys that I make and Mark makes, and even David Ryan, we're all looking for volatility contraction and buying from the right side of the base when volatility is very low. Volatility is not your friend. If you're a low risk trader or investor, you want low volatility, you want high alpha, low standard deviation. You don't want a lot of volatility because volatility is risk. And when we're using very low risk entry points, using tight stops and so forth, volatility is what will cause us a lot of grief. So we're going to show you how to trade the stocks that have that volatility contraction, and when they're coming from not only from a low risk standpoint, but when they have very explosive potential. So what I'm first going to do is I'm going to show you some examples, explain the volatility contraction, the contraction count, which I call it. And again, each of these counts, if you will, I used to refer to them as C's. Now I call them T's, tightenings. Basically, what they are is just each time the stock from peak to trough corrects, and then peak to trough corrects again at a higher level. So you have a higher low and a tighter range. So for instance, and like I said before, I'm going to show you a lot of stocks that we previously looked at. So, we'll look at some of these stocks that are in uptrends, and we'll look at them versus the general market, look at the relative strength to see if they're showing leadership characteristics. That was in the next section that we looked at some technical analysis. We looked at fundamentals and applied those to some of these same companies. And now, of course, we're looking at the base and the volatility contraction pattern that's within that stage 2 uptrend. It's real important that you think chronologically that all these charts that we're going to show you now and all these price patterns are going to be where you're already in a stage 2 uptrend. Okay, that's already been decided. You've already made that decision. That's your qualifier. So again, this would have a different meaning or a different connotation if these stocks were in a downtrend. If they're in a downtrend, a volatility contraction could actually be a short if it breaks to the downside. So real important for you to keep that perspective. So as you can see, these little red dots, these are just from here to here. That's would be your first correction in the stock, and you rally back. Your second, and you rally back a bit more, and now where it gets really, really tight. One of the keys about the volatility contraction, at least from how I trade it and how I've found that the grand majority, 98% of the stocks that really take off and make big moves, they generally they'll come from the tightest portion of the volatility contraction is single digits, and you can see here, of course, looking at WR Grace again, 29% peak to trough was the first pullback. Then as it rallied, it came back, and it was only 9%. Now that would get my attention. That kind of tightness would get my attention, and it did, because I bought this coming out right here. And then, of course, just a 3% tight little range, super, super tight, and that's exactly what I'm looking for. You'll also see that you got off to a really nice start here. And this is another benefit of the volatility contraction, and coming in when there's very low volatility, low volume, you get that explosive potential. Like I said, I'm going to explain to you exactly why that happens in just a minute. But we're looking for a great start. We really want to get out of the gate, if you will, and get at a profit as soon as possible. As a matter of fact, when David Ryan was here in previous years, he always used to say that's the number one thing that lets me know that I'm on the right track and I'm probably going to make money in the stock, is that I'm up right away at it, right away on the position, and that tells you that your timing has been you timed it correctly.
Another golden nugget there, Mark. And I just want to add, that's, I think, also another timeless principle, because even Livermore alluded to that too. Back 100 years ago, was the same idea of focusing on being right away. I just wanted to point out, though, this is a great slide for the difference between alpha and volatility that you were talking about. A lot of people, especially beginners, and I was in this camp, think if you look at that arrow where Mark says I'm buying here, ooh, that's volatile. No, it's not volatile. It's one-way price action for the first 2 days straight up. That's alpha. That's what we're looking for. And to Mark's, volatility is where it's cutting back and forth, up and down. And we want just the opposite, where it's tightening up, and then you get that burst of alpha in your direction as it breaks out.
Yeah, if you had a stock that went up 100% in 10 days and it just went up, 10% a day, let's say, for 10 days and went straight up, and every day it closed up, there'd be no volatility whatsoever because it's all on the upside. So that would be all alpha, excess return. So volatility, as Mark said, has to cut in both directions. The volatility is when the stock is whipping back and forth. You have to have upward movement and downward movement. And what we're trying to do always is create asymmetric leverage where that upside is much larger than the downside, and even we're cutting off that downside and then staying with the stock. And you can see clearly how we get off to a great start, but see this big move here where you've got 100 and almost 150% in 55 days. But look at all the pullbacks. There's not much pullback in the stock. So even as the stock progresses, the downside is limited relative to the upside. And that's where we create that alpha. We want to be involved in stocks that are having those nice moves up and giving back very little. And that's standard deviation too. We want high alpha, low standard deviation. We'll talk more about this later too. So FSI International, this was another one that I had bought and purchased going back in the 90s. As a matter of fact, in 1995 was one of my biggest years that I ever had. Certainly around that time, I was up over 400% that year. It was a real game-changing year for me with my personal account. And I bought this stock, and you can see on a weekly, came off about 18%, rallied back, and then just 5% on that right side. And this took off 130% in just 7 months. I'll show you the daily. This is where I was buying it right here. And this really sticks out. I mean, you can see it's incredibly tight right here. There's just no volatility whatsoever. And again, look at this wonderful start that you have. 1, 2, 3, 4, 5. It's like 6 or 7 days up. So once you get that type of start and the stock comes out of the base and breaks out and you're at a profit, what it does is it takes all the pressure off of you. And even creates a short-term situation where if you want to take the profit, you certainly could. There's a lot of traders that use this type of method, use my method or shorter term, and they're selling right into that. But again, even if you're going to play it for a bigger move, you now can go through pullbacks without much pressure, because unless it comes all the way back down and were to go back to your break even or stop you out, and that would tell you that there's something not right with the stock, because once the stock comes out that strong, it shouldn't reverse everything. And so again, that first move, look at the relative strength, just really outperforming the market. The market was moving up too at that time, but this stock was moving up a lot more. And that's that leverage we were talking about. So you want to get that leverage right on the hop, and then hopefully you got your tiger by the tail, and you're gonna leverage the market. Let me show you some more examples. I'm going to show you a bunch of examples, and then we're going to dig deeper, and I'm going to show you the nuances of the volume, the price, and really start to get more forensic. But I want to first explain and have you see some of these precedents, which you can use. You should be using these. This workbook is very valuable to use in the future. Mark, you've been to a bunch of these, as we said before. In the very first one, how did you use the workbooks and maybe even my books as precedent models?
Yeah, absolutely. Great point. I was going to make, and my laptop is actually sitting on a stack of old MTP manuals. I have tons of them that are full of notes. And one of the things, I did, especially after the first few years, was just page through all the different examples. And we're going to get to this a little bit later in this section, but the idea is just training your eye on what to look for. One of the other things David Ryan used to talk about is the idea of just focus on studying the perfect examples. And that will weed out all the other stuff. We often get questions, well, what shouldn't I do? Don't focus on what you shouldn't do. Focus on what you should look for. That'll solve, 90% of your issues. But absolutely, and the other section in Mark's first book, that gets into some of the philosophy, the technicals, which I know we're going to get into again, is also really important. But these precedents, you just got to hammer them, get that blueprint, embedded into your brain, so that as you start screening on your own, you're just training your eye and what to look for.
Yeah, absolutely. And that comment that you made about David Ryan, David used to say, when they used to teach people to look for counterfeit bills in the government, they would study a perfect bill. and then compare the bills to a absolutely perfect bill. And as opposed to looking for all the things that can be wrong, just start with what a perfect bill is supposed to look like and compare and contrast. And that's what you can use these precedents for, because you're going to see they repeat, and they may not be completely exact, but you'll be amazed at how similar these setups are. You'll be saying to yourself, "Why doesn't everybody do this? If it's everything is so repeatable." And there's a reason behind that too. And most of it's with regard to discipline. But again, very tight here. There's right here, 7% from 20 to 7 to 2. So this was so tight and had so little volatility that I bought this coming right out here. And you can see already previously in a stage 2 uptrend. Let me give you a few more. And one of the things I want to point out too is that generally what you'll see is you'll get 2 to 4 or 5 contractions or corrections in the stock, where you come off here 1, 2, 3, and it gets really tight. That fourth one, I've seen them go 5, 6. Very rarely do they go 6, 7 or more. Usually it's between the most generally it's 2 to 4. Sometimes you get 5. Very, very rarely you get 6. And if it goes more than 6 or 7, starts going 6 or 7, it's usually getting abnormal. So again, most of these you'll see that they contract about 2, 3, 4 times. But again, that's what forms, as we've talked about before, and Mark just mentioned Livermore. That's what Livermore referred to as the line of least resistance. And again, nice quick profit here. See, very explosive, right? And again, there's a really good reason behind that, which I'm going to show you in just a second. This was actually a stock I did buy. It says buy point here, but I was actually buying that right there. Cena Corporation. So here's one that's a little larger. And generally, when you get 5 or 6 contractions, it'll be a larger base. And I love those. I love the really large bases that have a lot of tightenings, a lot of contractions, and then at the right side they get really, really tight. Those have really explosive potential. They've given the stock enough time to go through a very natural process of changing hands from weak hands to strong hands, and then when you finally, the supply is really weeded out of the stock and there's no more selling, it's free to move even on a small amount of volume, and it can really blast off. This stock went up 52% in 23 days. And as I pointed out before, I refer to super performance, not just these big monster stocks that go up, secular, but even if a stock can go up 20 or 30% in a couple of days, wow, do the math, compound that. You don't need many of those. So we're looking for not only magnitude moves, where you get these long secular moves and the stock goes up hundreds of percent or thousands of percent, but also what we call velocity moves, where very quickly you can pick up 30, 40, 50% in a matter of days or weeks or even a couple of months. Can really could add up, and you can compound. All right, let me explain to you why this volatility contraction is so important, and why getting it right and really learning how to do this could really be very valuable to you. The first thing you have to understand is that this is not the effect. Okay, this is not the cause. I'm sorry, this is not the cause. This is the effect. All right, this doesn't work because people are watching it and it's popular. As a matter of fact, it would be just the opposite. But it is the effect of supply and demand. And what happens, and when you look at these charts, these charts are just human behavior on display. And so if you start to understand what's actually going on there, especially at key points within the chart, you really start to have the confidence, to utilize this, because you'll understand that the reasoning behind it is very sound. It's rooted in the most fundamental of all fundamentals, and that's supply demand. There's nothing more fundamental. It's like gravity, the law of gravity. So here's what happens. A stock will start to correct down that left side, and inevitably you'll have people that bought the stock around the highs, and so as the stock comes off, they're at a loss, and we call them trap trap buyers, right? They bought the stock, they're very quickly at a loss. And now somewhere around the lows, where the stock starts turning up, you'll have buyers along the way, and some of them would have bought around the lows or somewhere around the lows. And as the stock comes up the right side, you get a merging of the two that create supply. You get, first of all, these people that bought around the lows are at a profit. So you get some short-term profit taking, and that creates some selling, of course, and that intersects with some of these trapped buyers that are starting to get back near their break even. And as they start to recoup some of their losses or get back to break even, that creates some selling there. So now that creates that next pullback in the stock. So you get another, that would be the next pullback. But now, because you've weeded out some of that selling, so there's less supply, you don't correct as much. You correct a little bit less. And that same process happens all over again, only now you've got less buyers at that high because it spends less time, and you've got less buyers around the lows. And when you come back, that whole thing starts all over again, where you've got the trapped buyers and the profit, the bottom fishers taking profits again. And now it goes through that another iteration. But because you've weeded out even more supply, there's even less. So now the pullback is even tighter and even shallower and quieter, because there's less supply, less volume, until finally you get to where it really quiets down. And this is what lets you know that the combination of time and price and volume lets you know that the stock now has limited supply. There's very little supply versus where you had all this volatility. Now, and it's not perfect. I mean, could there be a big seller at a certain price? Sure, there could be, but it gives you a really good indication that supply has stopped coming to market. And when you get this supply imbalance, now this is all predicated on the fact that this is a stock that's in an uptrend, and you've got that institutional sponsorship that we're looking for. There's an appetite for this stock, and if you've got big earnings, you've got big sales, and you're in a strong uptrend, well, that increases the probability that there's something going on there, and there's an appetite for the stock. So now this is an intermediate or short-term correction in the stock. So what you're trying to do is get on board once you weed out these shorter-term players. And now the longer term trend, you're trying to get back in sync with that long-term trend, but bypass all the time to wait for it to go through that volatility and move sideways, because time is money, of course. And that's where when you have the institutional support and you have the supply demand imbalance, where you have very little supply, well, very simple, low supply and demand, low supply, big demand, explosive potential. As a matter of fact, if you have really low supply, even a small amount of buying will move the stock. So when volume comes into it, it just explodes. And that's why you'll see, all these charts that we're showing you, they come to these buy points very quickly, and you get at a profit very quickly. And that's our goal, to get at a profit as fast as possible. Before I go on to this next slide, anything on this one, Mark?
Well, this last concept is really important. And, again, the section in your book where you go over this is also, I think, for people to understand, that the pattern isn't causing anything. People think, oh, this VCP causes it. The VCP is just the effect of stronger hands are taking that supply from weaker hands. So in each of these iterations, where Mark is showing, as you're going up the right side, those stronger institutional hands are slowly gobbling up the supply from left to right. And then the most important point is when he was talking about, again, the reason we start with the stage 2 is you got to keep everything in context. So, and that WR Grace example is such a good one. It's already in that that longer term uptrend. Then you start to see that supply contracting from left to right, and you've got a really powerful cocktail then as the volume starts to dry up on the right-hand side.
Right. The bigger buyers are absorbing. They're absorbing
Exactly
that
right.
supply, is what Mark is saying. So let's put it another way. Let me show you another way. This is often an explanation that people really can understand and love. So again, trap buyers, bottom fishers, profit takers, and break-even sellers. Right. So think of it this way. If you ever take a towel and and soak it in water, and you pull it out of the water, and it weighs a ton. And then so you twist it and you wring all the water out, and no more water comes out of it. But then you untwist it and retwist it, and then more water comes out, but less water comes out. And then if you unravel it again and you re-ravel it again and you twist it again, more water comes out, but even a little bit less. Each time it seems like all the water's out, but it's not really out until you untwist it and retwist it back. So this is the same exact thing that happens with when you go through this VCP. As you're going through these iterations, it's wringing out the water. Think of that as supply. It's wringing out the supply a little at a time. And then when it comes off a little bit, it comes back. You go through that same iteration. It's like unraveling the towel and retightening it, and a little bit more water until there's virtually no water or very little water. And that's where we come in. That's what we want to try to get involved in the stock. Now, what we're trying to do here and pass on to you is to create where your vision, when you look at charts, you're looking for a footprint. You're right away, as soon as you look at a chart. I mean, if Mark looks at a chart and I look at a chart, it's really quite amazing. And even David Ryan, we could all look at charts and we'll spot almost all the same names. I mean, I can tell you, Mark, how many times do you say, I say, you know, what stock do you have? And you say, oh, I bought XYZ. And then I'll look at the chart and I'll pinpoint the exact day you bought without you ever telling me, right?
Yeah, we've played that game many times, and usually you run a perfect card.
Yeah, because there's this footprint, there's this look, if you will, as David Ryan used to say, you know, the look has the look. That look is something that we can look at a chart and right away know if it's got that footprint, because we're looking for that silhouette first. Then we get more forensic. But think of it this way: you know, if I told you, you know, this guy Jim I know is 6'5", he's 284 pounds, he's got a 46-inch waist, 54-inch chest, you know, wears size 13 shoe. Like, you wouldn't know exactly what Jim looks like, but you'd have a pretty good idea, you know, of his build, and he's a big guy, and you know, you'd get a good idea of a silhouette. Well, that's the same thing with this, where you're sort of your starting point, and this is what I call the VCP footprint. So this little acronym, if you will, right here, abbreviation, where it's 40W, 31/3, 4T, that's basically just explaining, you know, what this VCP footprint is for this stock right here, this VIVO. So what that means is it's a 40-week base. So it's 40 weeks from the start of the base to the completion. And the largest, 31/3, is the largest decline in the left side. And the tightest to the right is 31% and 3%. And there's 4 contractions, 4 T's, 4 tightenings. So with that, if you just told me 40W, 31/3, 4T, I would immediately be able to visualize that chart. And I know it's a pretty big base. It's not very deep in the first pullback, and it's really tight on the right side. And it's gone through 4 iterations. Like, I would be interested in that if I just saw that abbreviation. So I created this abbreviation. So whenever I now, you know, I used to do it on just a pad and pen, and as I was going through the charts, I would put down the abbreviation, and then I could later on, as I'm looking at the stocks and I'm watching them trade on my Quotron, I would know, you know, which ones were which. So think in terms of the footprint. I'll show you. Here's Netflix. So I was buying Netflix right here, and you know, quite basic, you know, 27% in the first decline, 17% from here to here, and finally an 8% with a real little tight little area right here, which actually you could probably call this a 4T. And then just as it comes out of here, that's where I'm buying. I'm buying right there. And of course, this stock went up. We talked about this before. Netflix went up over 500% in just 21 months, and then went a much bigger move after that. That was only the tip of the iceberg. If you take a look on a weekly, here you go, 27W, which is 27 weeks. 27/8, 27% on the first contraction, and 8% on the last, and it went through 3 iterations there. And
just
you can go ahead.
To point out too, Mark, that you know that you have the volume highlighted in the bottom.
Yep.
And I think 2 of those weeks were the lowest weeks in the entire basing period, but also since sort of the beginning of that move.
Yeah.
That's exactly what Mark was talking about. As it's tightening, that supply is drying up.
Yeah, very good point. And so with the volume, sometimes the volume will come down, especially if it's a smaller mid cap stock. It'll come down to almost nothing. And this sometimes scares people. They're like, "Oh, I can't buy that. It's so thin." But you want to look at the average volume. That's the first thing when you look at volume for this, for making a decision whether a stock is too thin or not. But you want that volume to come down as much as possible. If it traded no volume, that would be the best scenario, because that just means that there's no supply at all. So when you look back and you look at the base, sometimes you'll find it's the lowest volume in the entire base, or even in the entire move since the stage 2 uptrend. When you're gauging these things, you want to gauge them against the basing period, and since the stock has moved into a stage 2 uptrend. So you see here, stock moved into a stage 2 uptrend. Since it moved into a stage 2 uptrend, that's the absolute lowest volume. You got a couple of the lowest volume bars since that stage 2 uptrend. That's exactly what we want to see. That's teeing it up perfect. Let me show you another chart here, and you can see how we come off here, and then we get really, really tight. It comes right out quite nicely. Right away, you're at a profit. And you see the volume here, really, really low volume. It's some of the lowest volume. Again, if you go back to the chart here, and you can see it's the lowest volume. It's the lowest volume since you got into this uptrend, and it's the lowest volume pretty much in this base. And then you see the volume comes in, and that's the next thing you want to see. You want to see volume come in. Once it starts moving, we want to see if there's actual appetite for it. So now you get that combination of low supply and now heavy volume coming in, and that's how it gets explosive. But here's the thing: we go back to what Mark was saying. This is timeless, and it doesn't know time frame, because again, this is not the cause. This is the effect. And if you're using intraday charts, daily charts, weekly charts, this right here, what you're seeing is just that, from that area to that area in this one bar after this new issue. So this is just a 5-minute chart. So you see the exact same thing unfolds, even on an intraday chart. As a matter of fact, we have a lot of customers and those that I've instructed over the years that they day trade, and they use these techniques to day trade. You can use them, in that fashion as well.
I'll just add, Mark, too. One of our colleagues, Bob Weissman, he messages me all the time going, "Did you see the little VCP on the 5-minute on XYZ stock?" And I'm always like, "Bob, I don't day trade, of course," but you just see it all the time. I mean, if you learn to master this concept and become a specialist in identifying these areas, you can make a career really regardless of time frame. And people will be doing this. They've been doing it before, we were here, and they'll be doing it when both of us are dead and gone. This is a timeless principle.
Yeah. And Bob is something, many of you know Bob. When I first met, Bob's been with me for, I don't know, almost 20 years now. When I first met Bob, he was a day trader. He was day trading exclusively. So he to this day always goes back to those day trading roots and always spots things on an intraday basis. So now you can also get multiple buy points where you'll get these tightenings will happen, and we're gonna talk about this in more depth of the various buy points that you'll have and the opportunities that you'll have. When Square set up, it was pretty shallow to begin with. It only came off about 13%, which would get me interested just in that alone, because it's not correcting very much and it's showing that it's strong. But you can get multiple buy points, and you see here just a 5% pullback. So it's already really tight, then it rallies up a bit, and you get another little pullback here of just 3%. So 2 really tight points here. And everything that we do, whenever we're buying, we're always buying within the base or just coming out of the base, within the VCP progression, or just coming out of it. Once it comes out of the base, that's it. We're leaving it alone. We're not chasing it. We're not buying gaps and all these. So that's, maybe there's other strategies that you can do that, I guess. But we're looking at it within the base, and we only want to be buying within the base, because that's where the move generally starts. That's where you'll get that explosion, and you'll get that start of the move, and that's where risk is the lowest, and that's the key. We want to keep the risk really low. So I want you to look at a few things on this chart. Look at the volume and the price and the contrast between them. So even right here, you can see really low volume, right? So there's really a lack of supply here. And it looks like the stock is just waiting for the earnings to come out, because when the earnings come out, EPS of 109%, look at the volume that comes in, millions of shares, it just explodes. The stock has a 2-day run. So this is something that would get my attention, but I wouldn't buy the stock here yet because it hasn't gone through the VCP. Now over here, it actually did go through some VCP, characteristics where you got really tight. You were heading right into earnings, so that was kind of risky. So here now, once the earnings are reported, you go through a nice VCP. You get real tight over here, and you can see even over here where it's tight right here, the volume's low, and then you get that contrast. See, this is where you really see the contrast, where you have low supply but big demand. And that's where you can see that contrast here. You can see it here, and you can see it here. And you should be looking for it all along the way, within the chart, where you'll see that. Now, on the left side of the chart, when you get into big corrections, there will be big volume on the downside. And when you see that, you want that to be on the left side. That's okay. As you get to the right and the further to the right, and you start really tightening up, that's where you want the volume to come way down. So all this, as I'm going to go back to what Mark was saying, all this, what we're showing you, is to culminate to where we want to get you to a point where you're looking through basically the eyes of a template. So when you look at a chart, there's this template that is sort of like you put glasses on and you've got the template superimposed in it, and you look at charts and you're trying to find the chart that fits in that template. So I let the stocks come to me. I go through my screening process and I look for these stocks, but they've got to fit. They've got to fit that template. They've got to fit the VCP template and have those characteristics. And they've got to be first in a stage 2 uptrend. So the first thing we're going to do is the stock has to be in an uptrend, has to meet the criteria that we spoke about earlier. And it's in a stage 2 uptrend that improves the probabilities and gives us an indication that we've got institutions in there. We need that demand. Definitely need that demand. Then
I'll just add too, Mark, this whole section, I think, for folks, if you think of this whole section on the VCP as really learning how to put those glasses on properly and to look through them, it will, if you really learn this and master it, you will eliminate 99% of the stuff you don't want to be looking at. I screen hundreds of charts a day. Doesn't take me that long because, my glasses aren't as refined as Mark's because he's been doing this for 40 years, but they've gotten pretty good over the last, 12, 13 years. And that's really how you want to be thinking about this. It's going to slowly and steadily train your eye for what you really want to look for and finding those really opportune situations.
Yes, Mark has gotten good enough to make tens of millions of dollars, so he's gotten pretty good at it. and again, he's armed with the same information that you're getting. As a matter of fact, you came to the first Master Trader program, Mark, and it was I think the workbook was probably half the size of this. It was like 200 pages, and now we're at like 5 change. And we've refined it, and so much more. There's so much more now. And so again,
the irony, Mark, too, is a lot of it now. It feels like in the early days, I was just looking at all those examples. Now, probably half the names, most of the names from the last decade are all names I traded, or a lot of names I traded. So right. it is amazing. You look back and things have kind of come full circle to go, well, I saw that in real time. I saw the tightenings, the contractions, and I was able to get on board.
Yeah, absolutely. And you live through a lot of this. Again, most of these examples, we've traded. So now, again, another thing you want to, now we'll just recap real quick. Remember, stage 4, you're losing time and money. Stage 1 or 3, you're losing time, and stage 2, that's where you're gaining value at the fastest pace. That's the only stage you want to be in. So now, once we get into that stage, you're not going to have just one opportunity, and there's some earlier opportunities. Obviously, the earlier to get on a big move, the lower you're getting the price, and it would be a larger move. But sometimes the later stages, for instance, even here, you could see you move up a bit, but then the second opportunity that formed the VCP is very explosive, and you get a chance to have a very quick gain. And sometimes it's the third or it's the fourth. So you'll normally have, when you get a stock that's in a strong uptrend and you're in a bull market, you're going to have a bunch of opportunities. There's some stocks that I traded 10 or 15 times out of various VCP setups along the way of a big secular move and strung together a very big return. Again, just going back and recapping again, when we have the contractions, when you start getting into the 4 or 5 contractions, you're going to usually get into the larger bases. They'll be deeper, and then they'll need more time. So that's sort of a relative. You got to think you got to think in relative terms. When you have the larger bases, you want to see more iterations and more time frame to go through that. But here's the one thing you have to be careful of. You got to be cautious when you have a correction that's too deep. When you have a really, really deep correction, and as we showed you in Pictures Worth $1 Million, you always want to compare the price action of a stock to not only its peers in its group, but to the overall market. What's going on? Is this abnormal weakness? Is it outperforming the market? For instance, this stock right here, which was Mankind, this stock comes off 60% during a period where the NASDAQ only corrected 6%. So you had this little pullback, this very normal pullback in the general market, but Mankind comes off 60%. Now it comes ripping back up here. And right here, you can see, you could outline a VCP, but this right here, this contraction, if you will, is 25%. That's not single digits. That's way too deep. And that's why it fails. It failed miserably because you just didn't get the tightening. There's still lots of supply there. All that volatility tells you that there's a lot of supply. And then even here, I know some people call this a cup with handle, this big base here, and then call this the handle. But the handle was 20%. So you can't have a handle in 20% or a pivot in 20%. That's a base. It's just too deep. There's too much volatility. So it never got a chance to really tighten up. And sometimes these will actually emerge. They'll come out, but they'll run into supply very quickly because they haven't had a chance to go through that natural ringing of the towel. And now look at the decline, how this just runs into huge selling. So you got to be real careful when you have the deep corrections. Another one that was I got a lot of questions on back in 2015 was GoPro, 2014 and 15, when it came out of a new issue. It was ripping higher, and everybody was talking about it. And then it cratered. It went down 61% during a time where the NASDAQ was actually up 10%. And we talk about underperformance, 71% underperformance. This is the complete opposite of alpha, which we'll have to come up with an acronym for the opposite of alpha.
Well, one thing, Mark, that I found that helps people is think of it in the context too of, because we get a lot of questions about stocks with big breaks or a lot of supply to the left. It just means there's a lot of folks underwater. If you think about that from a psychological standpoint, they're in pain, they want out. So that's sitting over the top of the stock. Anybody who bought this stock, is GoPro above 60, once it makes that break, they're all underwater. So it comes back up, and these are going to take more time, and they're just massively more failure prone.
So, okay, let's talk about that for a second. That's a good point Mark's bringing up. So first of all, you've got lots of supply. To the left, you have lots of supply. There's lots of people with losses. So as that stock comes back, and when you have a really big decline, and there's inevitably going to be some bottom fishers, as it comes back and it marks back up, you get a large gain. All right. And the faster it comes back, the quicker these people start getting, back to break even, and these people get as we showed in the previous chart, get profits, and you create that selling, of course. But there's a lot of supply here, and with this big decline, it not only creates supply, but something's not right. Again, I mean, if a company's doing so well and the management's so good, right? We talked about differential disclosure. The management's good. The earnings are great. The sales are great. The profit margins, it's a great industry. Everybody loves the name. Why is it down 61% when the market's up 10? It also increases the odds that something's wrong. See, this doesn't make sense. There's no such thing as a good company. Even a good company, if it's in a downtrend and it's being sold off, Facebook's a good company. It's a sound company. Right now it's down 75%. you're gonna have to make a pretty big gain. If you're buying that now, you got a long way. Or, I'm sorry, if you bought that, up at the highs, because it was a good company, or bought it maybe when it first came down, you're sitting at a huge loss, and you got a long way to make that up. And you'd be one of those people that would create supply in the stock. So when you get that big decline, it also saying that something's wrong, especially if it's doing it during a time where the market isn't correcting. And so this is just a clear warning that you've got a faulty base here. And sure enough, it runs right into supply once again and can't rally. What you'll see this too is when you get into later stage bases. So you'll get the VCP, you'll be in a stage 2. This happens to be Decker's Outdoors, DECK. I was buying it right here, coming out of this base right here. And then you see it made a very orderly move up. And this is this is a logarithmic scale. So the moves percentage wise are the same. So now you can see pretty big base here, right? But comes out nice and tight, moves up nice and tight. If we were to put those dots on here like we did on those previous charts, you'd see all black dots. These are all new highs, all-time highs. Then suddenly you get the big break. Now the stock comes off, 50, 60%, and it still forms that big, cup with handle VCP, but this is faulty now. We're late stage. We've already gone through a number of VCPs and base breakouts, and see how nice and efficient this is. But then all of a sudden, the volatility starts picking up, and it gets wider and wider, and that's where you start topping. That's how you identify stage 3. The volatility starts picking up, and you don't want to be anywhere around the volatility. When volatility picks up, that's not your friend. That's your enemy, and that means there's a lot of supply, because now you've got all these profits that have been built up in this stock, and now you got the unwinding of those profits, and that creates a lot of supply. All right, let me show you something here. So we're going to talk about, I'm going to get a little more, we're going to zoom in a bit more and take a look at what we call the pivot point. Again, you go back to Jesse Livermore. He termed pivot points. He was using pivot points a little bit differently than I use it. But again, yes, he is I think the grandfather of pivot points. I've been using the term pivot points and using pivot points for the better part of 35 years or so. I want to show you exactly what we're looking for and where we're buying, and get a bit more forensic here. Now, if you remember, I showed you that chart, a couple of charts. It was Monster Beverage, I think Microsoft, Yahoo, the dots, right? The dots were the new highs, or the all-time highs, actually, in this case. So what we want to do is we don't want to sit in the stock while it's moving sideways, or you have that volatile period. We want to be in the stock when those dots are being strung together. So we've got these techniques and tactics to get on board, and of course, this, at least what we're attempting to do, is to get on board as the stock is getting ready or is just about to go into that up move, and you're going to start making those highs and making that big move. And you can see here where you string all the dots together. This is where we want to be in here. We want to be out here. We want to be getting ready right here. And then again, now you go through another digestion period. And once again, we don't want to be buying in here and going through all this time. We could be moving the money into something else and compounding that money. We want to wait until the stock starts moving. So again, as I said before, we're not looking for the lowest price. We're looking for the right price. And the right price is the price at which we buy, and very quickly the stock moves, even down. We even want, even if the stock's not going to work out and we're going to get stopped out of it, we want it to happen as fast as possible, because the sooner it stops us out, the sooner we can move on to something else. But we want to sit in there for 6 months in a stock, and then it stops us out. Now we've wasted 6 months. So, and if it's working, we want to be at a profit as fast as possible. So we've got that cushion. We can go through the pullbacks and maybe even take some shorter term profits along the way.
Just want to add to that, Mark, too. One of the things you'll hear us talk about is the idea of weak and strong hands. We're weak hands, and that last slide's a good example of how you want to try and be the last weak hand. So, as the train is coming in on schedule, you're jumping on right as it's trying to move. And to Mark's point, if that thing stalls coming out the gate, you just step off. That's the beauty of this entire strategy when it's, really being performed at a high level. It gives you that ability to, jump on the train and not have to sit there and wait and wonder, is this thing ever going to move? You should know what to expect ahead of time. And then it just allows you much better efficiency of your capital.
Yeah, let's once again talk about and define how we're a weak hand. We are weak hands, and proudly. So a weak hand is someone who is going to sell, easily, quickly if the stock moves against them, or sell or they're not holding for the long term, and they're not going to add to the position if it's down. Like a mutual fund will go in there and buy the stock, and when it comes down, they'll buy more. Those are strong hands. That's supportive demand. Me, I'm going to buy the stock. If it doesn't take off right away and it goes against me, I'm getting the heck out of it. So I'm a weak hand. So if, let's just say, let me get a little arrow here. Let's just say right here, I buy here. Well, a weak hand, this pullback right here is probably going to knock me out because I'm a weak hand. So, but if I buy here, if I buy right here, and I'm using PowerPoint here, so if I buy it right here, well, I can be a weak hand because it just goes right into profits. I don't have any pressure on me. There's no loss. So that's why we're doing it the way we do it, because why we're weak hands is because that's how we manage the risk. That's how we create asymmetric leverage. By having, let me put another, this is something I'm kind of doing off the cuff here, but let's just say here, by having this upside, that potential, okay, see, get that out of there, having that potential, but capping the downside, just say, we buy at that point there and we cap the downside, and our stop, we set our stop here, put that in red. So we've created asymmetric leverage. You see, we've got all this upside, but our downside is much less. And that's how we create the asymmetric leverage. So in order to do that, we have to be a weak hand, at least relatively speaking. But so by being a weak hand, timing is essential. Timing is essential, and that's the point Mark was making. Let me move on. I want to show you what these look like, what these pivot points look like, and then we're going to show you the different sort of floors that we have opportunities to get on board within the base. Remember, I said that we're buying within the base. So there's a number of areas that we will buy within the base, and I'm going to show you those. But the first and the easiest to identify is when the pivot point sets up very close to the 52-week high, or the all-time high, or the high of the base. So here you can see very tight. This is very clear. You're going through tightenings, iterations, super tight here. I mean, the volume difference, you couldn't see much more of a contrast. My God, look at this gigantic volume bar that comes in. This actually came out on a gap, but I think the day before, take that out. Yeah, the day before it broke out. So that's right there is where you would have actually bought right there. This is one that I did not buy, but it was a really great example that I was actually watching at the time and passed on it. I think it was going into earnings. I think that's what that gap was, if I remember. So here's another one. Here's CBPO, China Biologic. Now, again, 4 iterations going through the VCP, and again, they look a little bit different as far as, they're not exact, but if you take a look at this, and you take a look at this one's a little longer, maybe a little shallower, but same exact thing taking place, where you go through these tightenings, the volume tightens up when the breakout, the volume comes in. Here's VIVO. Now, sometimes these pivots, just because a stock is, well, I should say it this way, you don't have to have a stock go into new high ground for it to be a breakout, all right, or have the buy point. As a matter of fact, most of the time we're buying a little bit lower than the all-time high or the 52-week high. It's not going into new high ground, or it's coming off of a pivot point within the base. But generally speaking, we're within 5-10% of a high. All right, you want to be fairly close to the high. You don't want to be down and buying a stock that's 50% off its highs. Now you've run into that problem. You have lots of supply, right? So what you do is when you're looking at these pivot points and you're looking at the supply to the left, supply is always to the left. you're basically looking where the majority of the price action has taken place, where the majority, now you can see right here, almost all this price action has taken place right around the 17-ish level, right? So this is tightening up right there. That's exactly what we want to see. We want to see it quiet down right at the area where you've had a lot of the price action. And as you get further away, you've got some price action above here. And so that's not really supply, because it's a good distance away. It's in the 9-10 months away. And it only traded above that level for, I don't know, maybe a month, 20 days or so. So the combination of not being above there very long and being far away makes that supply less of a problem. The closer the supply and the deeper the correction, the more that supply is an issue. That's a general rule of thumb. Okay, so let's show you another one. So this was BB Stores, 1998. I bought this right here. This was a big winner for me. Came out real nicely, just took off. I remember it was like right off the hop. It was blasting off. You can see here, see how explosive, comes right out. 1, 2, pauses for a day, 3 days up, and just, it's very efficient. Alpha, just all alpha here. There's almost no volatility whatsoever. The upside far outweighs any downside or pullbacks. But you had to go through this nice long base here and form this perfect VCP. And here's where you got the volume contrast. You got another little one right here. There's your pivot point. You got a pivot point here. You got one here. So you got all these opportunities to buy. You buy here, you can buy here. You can, maybe you bought it and sold it, and then you bought it again and sold it, bought it again, or you add to your position. You know, if you're trying to make a really big gain in a stock and you really believe in the company, the fundamentals are coming through, that's more of an O'Neill type approach of adding to it on each base during a bull market. This is where you would be adding. But the key to look at here is what I call the 1-2 punch, where you have the low volume and then the volume comes in, and you're only going to know that in hindsight. You're at the end of the day, you'll see the volume, or maybe the stock breaks out at 10 a.m. and what you'll look for is you'll extrapolate. You'll see what kind of volume is trading. Maybe after it starts moving, you see what's traded in the first couple hours, and then you can divide that by how many hours in the day and get an idea of sort of what the run rate is.
Just to point out too, Mark, on that slide, that first buy point, you can see, you get what Mark refers to as the 1-2 punch, where the volume comes down, it's really low, and then you get that volume coming in. But to the prior point we've made a few times, those are institutions. If you look at, you've got 3 out of 4 days then up on really nice volume. And this is something, people ask every now and again, well, if we all buy together today, we can break the stock out, right? But we can't keep it broken out. That's where the institutions, when you see, how many above average blue bars after that first breakout do you see? 1, 2, 3, 4, at least 5 in the first 2-3 weeks. That's those institutions. They're creating this whole trend that, again, back to our analogy, the aircraft carrier is creating this really nice wake for us that we're riding.
Yes. And we're going to get later on, we're going to talk about not only are we talking about the buy point here, we're going to discuss exactly what to look for after the stock moves to the buy point to determine whether the action is normal and whether we're seeing institutional footprints, or if it's abnormal and the breakout isn't that strong. We'll be looking at that. That's a little bit later. Actually, I think it's coming up next, actually. And again, really important to determine whether you've got institutional buying or retail buying. Like Mark just said, retail buying can budge a stock or move it short term, but the only thing that's going to keep a stock really going and hold it up is persistent buying by big institutions. And that's what those are the backs that we're looking to ride. Let me show you some more examples, and then we'll come back to that concept. So again, here's the 1-2 where you get the contraction in volume, right? You can see really volume comes way down, way down here, and then bang, real strong volume expansion as it goes through that pivot point, very, very tight. And again,
that's a great example too, right there, Mark, how tight that is. You should know very quickly in an example like that whether you're right or wrong within a day or two.
Yep, I remember this when this chart came up. I got very excited, and I was actually looking at it over here where it started tightening up, but it didn't break out. So then it came in a bit. It had to go through another iteration, and then finally it tightened up here. The volume came way down, and I bought it right there coming out. Now take a look at that chart, and then you take a look at that's New Oriental Education, and then take a look at Melly here. Very similar. Very, very similar, where you got real tight here, and there's the 1-2. There's the contraction, and the volume starts coming in, and again, 75% in 13 days. See, to me, that's a super performer. You know, that's what I want. I want a stock that goes up 50, 60, 70, 100% in a week or two, or even in a month. I can string those together and make a huge return. So you want to think velocity, not just magnitude. A lot of people say, well, you do a lot, you swing trade, and they read about me or they see me on Twitter, and then so we're looking at all these stocks that made 50,000. Another one here. There's the 1-2. See the volume? You almost can't see it on the chart. It's the lowest volume in the entire, it looks like almost in the entire history on this chart, but certainly in the base. It is the lowest volume. It is not a coincidence that the absolute lowest volume took place the day before the stock exploded.
Mark, just to point that out too, you can see this is a really good example. This is one of the best examples of the towel getting wrung out so dry, because you can see the volume that came in wasn't that huge, but look at where it takes the stock. It's because it got wound so tight there on the right side. Maybe average volume then, this stock's 60% in 17 days.
It's a great point. What Mark's saying is that look at this volume through even this whole move. It's not like it's this gigantic volume that took place. So again, that tells you that there's very little supply, because it didn't even take a tremendous amount of volume to move the stock. So again, you're sort of like getting double coverage. When there's no supply, even a small amount of volume can take the stock up. But if you've got big volume, then it could be massively explosive. Let's look at another one here, because look at these, they're very similar. This last little part right here, where you get like a little mini volatility contraction, and this is what we call fractals. Have you ever heard about fractals? Fractals are patterns within patterns, and if you start seeing fractals within a nice big base, that is a really strong sign. When you get a little VCP within a larger VCP, very good sign, and that's what you want to look for. You can see here, this is a fractal where you got the big VCP, but within it, there's a little VCP right here, right? And very tight here. There's the 1-2. Again, 70% in 3 months. See, we're looking at some stocks here that are velocity moves. Netflix, of course, went up a lot more. It was a secular leader. Same thing, the 1-2 punch with the volume.
Even there, Mark, that Netflix had a little bit of fractal on the right side. That last little tightening there was a tiny little, little cup there on the right side.
A little VCP on the right side right here. You can see a little mini one within a larger, and it went through those various iterations. Shopify, most of you would know Shopify, nice and tight here, right on the right side here. You can see this had huge volume, big contrast in volume. That was the liftoff. Another thing that you want to make note of, and that is that you don't need huge volume to stay in the stock. All right. We're looking for that first liftoff. When you first come out of the base, that's where you want to see the volume, and it doesn't have to be on the day of the breakout. It doesn't have to be the day that it moves to the pivot point. It might come in 2-3 days later. As long as it holds your stop and the stock's acting well price-wise, you stick with it, and you start to look for those signs, those institutional footprints over the coming days. And that's important. Again, we're going to get into that in a little bit of when we look at confirmations and violations. I just want to keep showing you some examples here just to burn some of these in your head before we move on. Quest, yep, I bought this one in 98. Again, look at the volume, comes way down, and then we come out really strong here. Look how tight, super tight, and you go through these iterations. Look at, oh yeah, that's right, Night Bridge Tankers. This is one that and you often hear Mark and I talk about how we stay away from sometimes the cyclicals, the oils. This is one that I actually stayed away from, but I was watching it and entertaining the idea of buying it. I did not, and it just blasted off. It was like, a couple of weeks later, it was up 44%. I thought it was a good example. Now, you can get multiple buy points within the base, and this is, as we move forward, we're going to get into more and more expert techniques. Like in the beginning, it's going to be very mechanical. We're going to show you, a couple moving parts, but then we're going to get lower in the base. We're going to start there's other buy points, which we're going to get to in just a second here. And there's multiple buy points. There's staggering. There's pyramiding, and we're going to get into what I call more expert techniques, and that will build upon. You start with the with the basic techniques, and then everything builds upon those. So that's why I'm showing you example after example. I'm going to give you that foundation, and then everything is going to build. Remember what I said. Every single thing in this entire workshop builds on the previous. Nothing that I say in the current time frame erases anything that I said prior to that. Everything will build on what I previously told you in pretty much in chronological order. So now, again, you see there's a couple buy points here. I mean, you can be buying it right here. It tightened up enough, but it didn't really just take off just yet, but it stayed nice and tight, and the volume came down again. And you're getting that same 1-2 characteristic even on both buy points. You see, it didn't just take, like I said, it doesn't have to just take right off. It might have needed a little bit more time, a little more digestion, another twist of the towel to get some of that supply out. Once the supply's out, bang, then the stock can take off. Now, we do buy even lower. That's like, remember the commercial, wait, there's more? Well, we do buy even lower in the base. All right, there's 3 spots, which I'm going to show you. Just want to see, where is that in the chart? Yeah, it's coming up in 2 slides. There's a couple spots within the base. Remember I said everything that every stock that we're buying is within the base, within the VCP. Once the stock takes off, that's it. We leave it alone. Hopefully we're in already and we're enjoying the profit. But there is what we call the cup completion cheat, which is simply we refer to it as a 3C, which is cup completion cheat. It just means that, and I'll explain to you how this even came about. Back when I first started looking at charts and so forth, like many of you, I read O'Neill's book. I subscribed to Investors Daily, and matter of fact, I had the very first Investors Daily that ever was printed. That's how early on I was reading Investors Daily and reading O'Neill. And of course, I read about the cup with handle. I read Giller's book about the saucer and platform. Discovered that that's where O'Neill got it, and he retermed it. Started looking at applying it and started using those techniques of buying cups with handles. And a friend of mine, we used to talk. He was a stock trader. We used to talk on the phone all the time. And I started recognizing that there was a little handle phase or pivot point, like we're talking about today, that was forming lower. It didn't have to be way up by the high. We were looking at stocks that were making new highs most of the time. I noticed 5-10% in the base, in the mid portion of the base, there was this pivot point that would form very often. And what happened was it would come up the right side and it would pause, and then I would say to my friend, I would say I cheated. I bought before the stock fully set up, and I cheated. So he said, well, that's where it completes the cup. Like, that's the completion of the cup. When it completes the cup, it forms that little pivot in the lower area, and we can buy it there. That, I think that's a safe place to buy it. So we started buying there, and that's how this term was coined, if you will. So here's how it looks. And this was a stock that, actually, this was on my very first blog, right, Mark? You remember this?
I remember this one very well. Yes. This stock absolutely blasted off too.
It did, yeah. I started a blog. Someone told me to blog, and I started blogging back in 2000. I think it was around 2010. And the very first stock that I put on my blog was this stock, but it was at this point right here. It was right before this took off, and I bought it. I bought the stock right as it came out here. but there was a buy point previous where we call the cheat. Right here would be the cheat, where as you complete this bottoming phase, now I could have bought it here. I could have bought some here. But then it tightened up even more and it got really tight. Look how tight these 2 days are and look at the volume. See the volume right here? Again, this is not a coincidence that the day before the stock explodes and then went on, it just took right off too. That's the lowest volume. It is like pretty much the lowest volume in the entire base for sure. And almost all this lowest volume or second lowest volume. It's no coincidence that it's happening on cue like that. That's because the supply stopped coming to market and now that demand comes in and it just explodes. Happens time and time again. This is timeless. You can go back and look at charts from 1896. You'll see this exact same thing happening over and over and over and over. So here are the 3 potential buy points. So the 3 buy points that we will try to get on in an emerging stock. So the stock's in an uptrend already, right? It's already in a stage 2 uptrend, and now it goes through a pullback, a correction. Let's say it pulls back 25%, starts running up, coming up the right side. Well, that first pivot point, which we call, and I haven't even showed you the low cheat yet, but that's next. So the low cheat is actually even lower than the cheat. The cheat is in the middle third, the handle's in the upper third, and the low cheat is around the bottom third. And that gets even more expert, which we're going to get to in just a second here. Let's move forward because we looked at this chart. Let's go up to, okay, let's look at 189, page 189. So this is Baidu. So again, you see the cheat here? So you've gone through that volatility contraction. You've contracted here. Now, as long as the tightness, the price tightness in that lower pivot point in the middle third of the base, as long as it's in single digits and the volume's contracting, you can buy it there. You can buy it there. And sometimes when things are ripping and the market's doing well, we put our whole position on right there because sometimes it doesn't even set a handle. It comes out of the cheat and it just takes off. So this is, think of this as, if this was the 10th floor to get on and we're looking to ride the elevator up to the 30th, this maybe is the 5th or 6th floor, right? And this is the bottom. This would be the basement right here. So we have these various techniques to get on board up that right side. We want to get on board as that stock is heading towards those dots. And we want to get on board somewhere up that right side. So we have these various levels that you may get a cheat, you may get a handle, you may get a cheat and a handle, but you very seldom, a stock will go through, will form a base in an uptrend, a strong uptrend, and go through this VCP, these iterations of tightenings, and you don't get at least one of them. So you'll get these opportunities. Let me show you a couple others. So here's Microsoft. I was buying right here, coming out right here, and then it formed this handle, if you will. You got a follow-up buy point, so you got a couple. You had the cheat, and then you had the handle. Take a look here. So this is one that doesn't really form. This is sort of, right in the middle. So you call this the middle third. I would call this a cheat, but then it just comes right out. It doesn't form a handle or an adjacent pivot point. It doesn't really matter what you want to call them. It's just simply pivots that set up in the lower third, the mid third, and the upper third are what you're looking for. And the lower you get, when you get down, the lower you get in the base. The issue is that you have to be more cognizant of the supply to the left, because as you go down, you've got supply, right? When you're at the highest level and you're breaking to new highs, there's no supply. You've cleared it all. All the buyers are happy. They're all at profits, and you cleared out all the people who had losses. So now the stock, that's why the stock's free to run. But when you're coming off the lows, you're going into that supply, and the deeper you are, the more supply there is. So that's why it becomes more of an expert technique. As you go down into the base, the cheat areas and the low cheats, you've now really got to assess the supply to the left correctly. All right.
Another example there, Mark, too, of I think it was 1 or 2 days before it came out, lowest volume in probably the history of this chart right there.
Yep, right here, right there, very low volume. Yeah, pretty much. Yeah, that looks like that's just about the lowest volume. It was maybe 1 or 2 days that were even close to that. So yeah, lowest volume, again, no coincidence that the volume is drying up right before it takes off. So now here's one that you won't really get. It's pretty flat and tight to begin with. You get a shakeout here. The lows comes ripping right back, and you don't really get anything, a low cheat or a cheat. It just forms a handle here. It's right up by the highs. So you don't get an opportunity for that. You only get one opportunity. Sometimes you get all three. You get a low cheat, a cheat, and a handle. And very often, and I know Mark does this a lot, he'll start off and start his position. If you get the low cheat, he'll start a smaller position, maybe a quarter of his position. Now it sets up another pivot. You add, and you maybe bring it up to 50%, 20 or 75% position. And then as you form that final pivot point up around the highs, now you're working with some profits, and now you add to that, and now you get that average price somewhere in the middle, and that lowers your average price. Let me show you with the low cheat, right? The low cheat, I love to use the low cheat on IPOs, recent IPOs, which we call a primary base. We have a whole section. We're going to talk about IPOs later. I like to look for the low cheats on particularly the big cap IPOs, the ones that are really, they're real popular. And then like Facebook came out, when it first came out, IPOs, it was all the rage. Everybody had to own the shares, and it just fell apart. LinkedIn was another one. These stocks very often will correct 50, 60% right off the IPO or shortly after. And then they'll give you that opportunity, that low cheat. And Google was one that set up, really quite perfectly, and never formed any handle, any other pivot. If you didn't buy it at this low cheat, it just ripped up right from there and just took right off. And of course, it went up over 600% in 40 months, but it went up a lot more than that, much further out. So here it is. There's what it looks like. Just in the first 40 days, it went up almost 100%. You had a double. So very, very efficient. Excuse me. Let me show you another one. Twitter was one that set up almost identical. And again, you get the IPO, and right off the IPO comes right off. Not a big correction. That's why this was a pretty solid low cheat, because you didn't have a whole lot of overhead supply to contend with. But in just 16 days, it ripped up 77%.
Both those examples, Google and Twitter, you can see too. Literally, the stock traded the lowest volume in the history of the stock in that little low cheat, because it only been trading for 3 or 4 weeks.
Yep, real low volume here. And again, you see the volume started to come in as the stock started to move. You didn't have to have the giant volume as soon as it took off. But as you started getting into new high ground, that's where the volume, and they really started to pile into it. Here's another one, CFLT, Confluent. These look so similar, where they're almost identical. And again, you did get a little handle phase here, if you will, and you came out and stalled out a bit, but again, a perfect low cheat. Now again, you've got to assess where this is really dangerous is when the decline, if this decline was, let's say, 60% in 4 weeks, I would not be buying this. And if I were, I'd be buying a tiny position, and I would take very little risk, because there's just too much supply. So you've got to assess the supply situation. The shallower it is, the more you can play that low cheat with confidence, and maybe position size bigger. I don't know if you, Mark, I don't know if you have any general rules. Mark and I have never rehearsed for this. This is literally completely off the cuff. He hasn't even looked at the slides. So we're just doing this off the cuff here.
That point you made, Mark, is really important though, about, look, the bigger the decline, the more trapped overhead supply you're going to have. And, Mark always says, look for traffic to the left, meaning if you're figure this is a one-way street where we're looking left before we jump out. And even in this example here, it did stall out at the old highs there. Well, that's because, this is a little bit bigger pullback, probably say, than the Twitter or the Google example. So it's just that natural, your trapped longs were probably getting out there before the stock then went higher.
I should probably have little cars right here driving this way, because it's a one-way street going left to right. So
exactly right.
You're crossing, think of it crossing a street. It's a one-way street. All the traffic is going to come from the left. So you're going to look at that, assess that supply on the left side. All right, let's move on a few more. You might remember Vroom, VRM. So this had some supply here, but it came ripping out quite nicely. Not much though. You see, you're only traded there for, I don't know, 1, 2, 3, 4, what's this, maybe 8, 9 days. You traded above that level, not a very, huge decline here. So not a lot of supply. Probably I did not buy this, but this is one that I probably would have been buying very lightly here because it did have some supply. I did buy this one here, this ICPT. I bought it at both these points right here. I remember this actually quite well. It was actually a big decline. And I still bought it here because it was so tight and it just took right off. And then up here, I got even more aggressive on it. Let's see, let me show you a few more, and then we're going to move on. Here's another one, very tight. You can see comes out, and look how efficient the move is. It just comes out very quickly. See, you don't want to be in all this. You want to be in this. This is the alpha. This is where you get lots of upside, very little downside, not much standard deviation. So there's not much volatility, not much standard deviation, and you get a lot of alpha. You might remember Tilray. We talked about this earlier, compared it to Macy's. It's a big company, and this was a small company in the marijuana space. This stock went up 1,000% in 28 days. It came right off of a low cheat. And that was your opportunity. You had a couple opportunities to get on board right off of that low cheat. So here's a BDSI. Again, here's your first buy point, and then you get another buy point right here. These are those multiple buy points. Sometimes I'm gonna fast forward just over one here to just here. Sometimes they're more creative too. This is a real creative a low cheat. And again, see, same principles though. The volume, see how it dries up, and then the volume comes in. And same thing here, you tighten up a bit, volume comes down, you get the 1-2 punch right to over here where you get the little, there's a little mini fractal, 1, 2, 3, 4, 5, 6, 7, 8, 9 days. Even on a 9-day time frame, look how you get a little VCP. Those are fractals, patterns within patterns. That's what makes it so strong. All right, so with what you've learned so far, the question is, would you be buying here? Is this a proper setup? And we don't have an audience here, in the live audience, where or an audience that's can respond right now. So I'll let you answer that, and I'll give you the answer. The answer is absolutely. Not only is this a really a perfect setup, it is a cheat area. You actually had a low cheat also. I think it's right here. There we go. Page 206. You had a little low cheat right here, where you could have bought some there and then actually add it to your position right here. Or if you passed on this one, then certainly you could have been buying here. But again, look at the explosive nature of this. In 14 days, it goes up 100%. It's no coincidence that you're getting these volume bars on the upside in big contrast to very, very light volume, because that's the supply demand picture. And that's what you're going to be trying to achieve each time that you go into a trade. You want to go in there when the supply is low and look for those stocks that can have very explosive price action. Now, what we're doing here is we're waiting for a change in intermediate and short-term trend to get back in sync with the long-term trend. So we already know that, everything I just showed you with these pivot points, the low cheat, the handle, what that's accomplishing is that you're not just trusting a broken downtrend. All right. If you were to buy and just draw a line, you can go back into the into standard technical analysis and draw trend lines and so forth. It's not very useful. It's not very useful, because the problem with drawing a trend line and having the trend broke, what happens is the stock will redefine the trend. So it'll break the trend, then make a new low, and now you got to redraw the line. And then it'll break the trend and make a new low, and then you got to redraw the line. And each time the volatility widens and widens and widens. So when a stock is correcting, the most volatile period is usually around the bottom. So that's where you'll get it making these big whipsaws back and forth, and you'll just keep redefining the trend. So what we found is that another problem is it doesn't take time into account, doesn't allow the stock some time to stabilize and to prove itself that it can start moving up off the lows. Again, we don't want the lowest price. We want the right price. So we want to see some stabilization. Now, the stock's already in an uptrend, right? I know I've said that 15 times already, but I'm going to keep saying it. The stock is in an uptrend. Now you're in that correction. What we want to do is we want to time getting back on that uptrend, coming out of that intermediate term downtrend, but we want to make sure that we've got the symmetry, that the stock has had enough time to go through that natural wringing of the supply, getting the water out of the towel. So to do that, we want the minimum that we want to have the stock require is that it marks itself up, pulls back, and then is able to take out the high from the pullback. And that's what I call it making the turn. All right, where the stock has made the turn. And sometimes you can have a pivot even below. You'll see in those charts where there's a pivot and it's below the turn, which that's getting in a bit earlier. That's like the low cheats, and sometimes you can get in before the turn. But that breakout from that pivot would cause the stock to make the turn, and that tells you that now the stock is now in gear with the longer term trend, because now the shorter term and the intermediate term, all the trends are in the same direction. That's what you're trying to accomplish. Now, talking about giving the chart time, we're not going to just guess. All right, there's ways of looking at this, and one is what I call time compression. This is another term or form of analysis that I've invented, if you will. I've actually never heard anybody talk about this except me, and I've probably been talking about this now for well over 20 years. But time compression is, just think of if you had an unsymmetrical U or V, or if you were to have a chart and then you were to push it and squish it over. So now it were to look like this, right? Versus here, we have that right side, those fractals, that tightenings. See here, there's no tightening. There's no tight. You're in the most volatile phase right here. So we don't want to trade around volatility. We want that volatility to subside. And then once the volatility is quieted down, we're looking to get over here. Again, not the lowest price, the right price.
Mark, just to highlight too, that last slide, this is a classic one to kind of cement in your head, because the left example is what I see a lot of rookies and amateurs doing, meaning they're buying right where it says no there is usually where they're buying, because a stock or is moving up and it just looks like it's going to go to the moon, and it sucks in buyers. And then guys like Mark and myself are waiting for that right hand example, and often on the backs of the less disciplined. They're getting rinsed out and rinsed through in that process to the right. And if you can really learn to understand and master this concept, you'll guarantee that you'll be in situations that are far more repeatably explosive.
So I often say that when you're, and this is a paraphrase of Bill O'Neill. Bill O'Neill said this. He said, when you're doing nothing, those that are less skilled, those that are less disciplined, are laying the groundwork for your success. That one sentence literally made me a multimillionaire. That I took that sentence to heart, and when I finally realized what that meant, it was worth a fortune to me, and I always pass that on. And this is one of those times where we're going to look at what not to do, but the way we're going to do it is we're going to look at what not to do and contrast it. Okay, because what happens is what not to do usually occurs before what you should do within the same chart. And this is exactly what Mark's talking about, where you'll have an amateur will be buying the stock over here as it runs up here, and it's not sustainable and hasn't gone through the VCP. Now, let me just say this. It does not mean that a stock can't just shoot off the lows and take off. That happens all the time. All right, there's definitely stocks that will take off. Not every stock is going to go through a VCP before it makes a big move. However, as we pointed out earlier, we have to have reference points, because when the stock's in no man's land and I don't know what it's supposed to do, I don't know that train's supposed to come in at 6:05. So if it comes in at 8:15, 8:15 doesn't mean anything to me because I don't have the reference point. So we've got to have those reference points, first of all. So when we, and on top of it, this is based on not just my own, my own idea of what should happen. This is based on going back, looking at all the biggest winners. When did they start that big move? And that velocity portion of the move where you got the alpha and the volatility was low and the upside was big and the asymmetric leverage, you could time that asymmetric leverage. Where did that take place? Well, it took place once the stocks went through these iterations, and that's where the risk was the lowest, because this is the law of supply and demand. Now, again, you certainly can have a stock that just takes off the lows, but it has to be something that can be repeatable. Can you identify it, and can you take advantage of it regularly and manage your risk in relation to reward? Those are the real questions. Not does it happen? Okay, it happens, but can you identify it, and can you utilize? Is there a strategy that can be built around it where you can do it not only over and over consistently, but year after year? And that's the difference. This is timeless. What I'm showing you is timeless. So here, this is not, you would not want to be buying this right here. Okay. Now as you go through the iterations, actually right here, see, look right here, there's a little tiny little VCP right here. So you actually have a low cheat right here. Then you set up here, you have a little, look at the little VCP. See a little tightening? You can even call it a little cup with handle. See, that same little pattern is going to happen over and over and over. And you want them to string themselves together and get to a point where, and you see right in this tight area, look how low the volume is. Right there, the volume's really low. I would actually started buying right there, 1, 2, 3, 4 days prior, and then maybe even add it to my position. 1, 2, 3, 4, and there you go. You're set up. Let's take a look here at Troy Group. Look at Troy Group here. See, it runs straight up here, but it's not enough time yet. It didn't have enough time to build out that right side and to really tighten up. And now, where you spend that time, you put in that time. There's no compression now. No time compression. You've moved out the right here. You've gone through a number of iterations. See, the volume comes way down. Look at the contrast in volume. Look at that volume the day before it unleashes, and look at the volume the next 2 days on these explosive bars. That's not a coincidence. I know I've said that 5 times now. I want to say it a 6th. It's not a coincidence. All right. There's a reason behind that, and it's identifiable. All right. 146% in 14 days. How'd you like to have a couple thousand shares in that? All right. So now, sometimes it's really the contrast between the compression and the correct buy point is incredibly obvious in hindsight. At the time, this might be on earnings, I don't know, some announcement, and you get all excited about the stock, but you got to revert back to the chart and have it temper your enthusiasm and make sure that the stock is setting up properly. And you got to have that discipline to wait. And to wait. If the stock just takes off and blast off, you got to let it go. You got to let it go, and you just got to pass on it. Mark, you are as good as anybody I know at passing on trades and waiting for, you are like the tiger in the brush waiting for a little baby antelope that's lame. I mean, you're not even, you won't chase anything unless the chances of success are really, really high. So, I would defer to you to, how do you do that? How do you keep that disciplined?
Well, yeah, one of the things you alluded to this earlier, in terms of your reference points, and this chart right here, too early compressed right side. If you buy right there, if I do that type of buy 1,000 times, I have absolutely no confidence. I mean, I have confidence I'm probably money down, certainly not money up, because to your point, it has not gone through the proper process. So, I tend to be a creature of habit. Little wins lead to big wins, little successes to big successes. So if you buy, though, at the correct buy point here, it doesn't guarantee you're going to be right every time. But if I buy there 1,000 times, I'm not just ahead, I'm way ahead. So I would much rather wait, and there are no called strikes in this game. It's not like playing in a poker tournament where there's blinds or whatever. You can wait. The problem is, to your point, is that tends to test your personal resolve and discipline and those other things, which we'll get into later. But I just think about it in terms of, I'm always asking myself, if I did this 1,000 times, where would I be?
Right. We're looking to play aces, kings, queens, premium hands. Just like in poker, we want to play premium hands. The difference is, in poker, You're in a poker tournament. They raise the blinds. You're forced to play inferior hands. Otherwise, you get eaten up with the cost of playing the game. Well, you don't have any with stocks. You don't have any cost. You can sit and wait and wait and wait, and only play aces. So how could you lose if you played poker and you only played aces and you never never had to put up any money? I mean, the only way you can lose is if the other players, so this guy only plays aces and they adjust their play for you, but that doesn't happen here. That doesn't happen here. So now, just going back to this chart, some would look at this and say, well, this is a VCP. It tightened up right here. But again, there's time compression. It's too short on this right side. You haven't gone through those iterations. So while you could try this, and in some cases it might work, if it's really, really, really strong and there's this, maybe some surprise news that came out of nowhere. But like Mark just said, if we buy it here, coming out of this little short right side, versus buying it after, let's just say we bought 100 stocks that look like this and 100 stocks that were short, the 100 stocks that have the better formed right side are going to absolutely outperform the others. There's no doubt.
And I don't know, Mark, I'm guessing you would agree with me, but it does seem like this is an area a lot of people struggle in, especially early on, or we see lots of people calling things a base where it's 2 or 3 days, or everybody wants to get in, after just a couple of days rather than giving it that time. Again, if you put all these things in context, we're trying to give the stock, the time to go through this natural process of contracting and tightening from left to right.
And that comes from two things. One is a lack of experience, that you just don't yet know what to look for. And that's why you need to use these precedents. This workbook is priceless for that. So you should be looking and comparing and using the precedents and looking at current charts and comparing them. And you'll start to see there's these similarities. The other reason is the eagerness to get in. You want to buy. So you've got this eagerness to get in and play the market. And that can really be, that's a form of FOMO. So you got to get really, disciplined and mechanical with this, where you wait for those setups. You let the stocks, I often say, I don't pick stocks pick me. I just watch them, and then when they get to the point where they meet the criteria, then I put my buy order in at that price when it goes through the pivot, and I let the stock tell me which stock I should be buying. And the first ones that move through that pivot, those are the first ones I buy. I don't even have favorites, and okay, this one looks better than the other one. There's basically a baseline of criteria that has to be met. And when it meets that, whichever one starts moving first, I get that first mover advantage. So you want to let that right side develop. So you got that downtrend, you break the downtrend. When you get that first pullback after you break the downtrend, that's where you've made the turn, and that's where you can start buying, because that's where now you're back in sync. You're back in sync with the longer term trend. Here now, one last thing. We talked about deep corrections. Now we have to be careful because there's a lot of overhead supply, right? So when you get that deep correction and you couple it, this is where a really dangerous situation. You get a deep correction and you get the compression. You get the right side compression where it runs straight up the right side and doesn't go through those iterations. You get into a very, very dangerous situation where you can come crashing down very quickly. Here's a stock. This is Travel Zoo. I remember this really well when it was setting up, because there was a bunch of people saying, this is a cup with handle. This is setting up perfect. And it wasn't perfect. It wasn't perfect at all. First of all, you had the stock off 50% when the NASDAQ was only down 10% during the same period. So it was already showing tremendous underperformance. Then it ran right up the right side and had a compressed right side. It did, for having such a big decline in such a short period of time, you needed time to weed through that supply. You had to go through those iterations, because as you're going through those iterations, that's telling you that supply is being absorbed. It's telling you that there's some strong hands. Like each time it tightens, it's saying strong hands just absorb some supply, because now it gets tighter, which means that there's less supply. If it got wider and it started trading all over the place and volume went up, well, that would mean that the supply wasn't absorbed. So you got to get that evidence, and you don't have that evidence here. And sure enough, this came out here, and 3 days later, whoever bought that breakout woke up with a very sad morning on that gap. So it just comes crashing down, and that's due to all that supply. Okay, now I want to back up a little bit. What we're going to start looking now a little more forensically. This is sort of like we just looked at like a fingerprint, and we looked at the whole thing, and then maybe we looked at the tip of it. But now I want to go within the fingerprint and start looking for some of the things that you want to see within the base. And again, one of the reasons or the evidence that we have some demand, because again, we're looking for that tightness in price, the low volume, to determine that supply has stopped coming to market, but we still need demand. So one way that we know there's some demand is because it's in a stage 2 uptrend. It's in an uptrend, you've got that inertia, but we want to see something more immediate, something that's closer to that buy point that's going to develop. And that's how the stock acts around the lows, coming off the lows, coming up the right side. Down the left side, it could come down crashing on big volume. That's fine. It's correcting. The volume's coming, they're selling. That's clearly where there's selling. There's a lot of supply and they're selling. But when you come up the right side, and very often this will happen on news, and you know, somebody might buy the stock. Some people buy the stock on the news, but the news has to also meld with the chart. Okay, and very often the news will come out, and then you'll get that set up later on. It'll take a little time. You'll get that post earnings drift, but you needed some time again to weed through and weed out some of that supply. So this was a perfect example. This was Dick's Sporting Goods. I bought this over here. We're gonna look at this later on, but I bought this right here on April 1st, 2003. But what got my attention, it was setting up here. And it was tightening up right here, and then it came off. It fell apart, and it looked like it was curtains. But they upped guidance, and the stock just exploded on a gap. And then from there, it just started staying quiet, and it got really tight. So, and this is an IPO base. It's a recent IPO, and with IPOs, we have a whole section on IPOs. I'm going to talk about that later. But with IPOs, you may not have enough history, price history, to be in a stage 2 uptrend. So now you're just looking at the price base itself, and you'd like it to be in some type of uptrend. You can maybe use the 50-day, but sometimes you just have, like right here, you just have a very short amount of price action, and this was buyable right here. This is a smaller base, but you can see same thing applies. Tightens up right here, and bang, comes right out. I was looking at it over here after they upped guidance, and you had that nice response when it tightened up, and it really tightened up on this right side. That's where I bought it right here. Let me show you a couple others. So even with this one that we just looked at before, that was massively compressed on that right side, look at the huge demand. So that's telling you that there's big demand. Now you just need to wait and get yourself on board on a low risk buy point, which you need the volatility to calm down. You need the stock to calm down. And again, that's going to probably happen, or very often it's going to happen at a higher price. We don't want the lowest price. We want the right price. Here's another VCI. Shakes out the low. See, right up the right side. Look at the big volume up the right side. But see, that's not where we're going to buy it. We want to wait till we get that right side development. Once it develops that right side, you can start buying some here. And then you really start to tighten up quite nicely right here. You see low volume, and there's the 1-2 punch. It comes out, and then you get the gap. The next day is probably going into earnings, though. I don't remember that one. This was Elan. I bought this. This was back in 1990, going to 91. You've had a very large up day, big volume, and see now you get the right side development, and then look at that tightness right there. It's 1, 2. It's like 3 days. Look at the volume. See how it comes way down. 2 days before it breaks out, it's some of the lowest volume in the entire history of the stock during that last year or so. Again, looking back at this was Cirrus Logic. Now, here's another situation that happens very often where a stock runs up in anticipation maybe of an earnings report, or the company might even raise guidance. It's a surprise. And it runs up and it's way extended. There's no base whatsoever. So you wouldn't be buying it here. But I take note of that. All right. If that can hold relatively well, especially I look for those stocks that had good news. They blast it off, and then the market corrects. So now the stock comes in because the market's weak. That's exactly what happened with Cirrus. This is how I got on board this name. They raised guidance, stock blasted off, great response to the news, but the market corrected. The general market started correcting. But as soon as this stock came right off the lows and started forming buy points, so that's where this is the one that I blogged. Again, same thing with AMSC. See, up the right side here, I would never buy here. This stock is very risky. There's no base. It's extended. It just came on a big gap. And now, look, it takes all this time to correct. See, if I'm buying it here, again, ultimately, I may be right. If I want to take the risk of holding a stock, buying at $13, $14 and holding it down to $9 and being at a 40%, a 50% loss, I'm not managing risk very well, am I? So and going through now 1, 2, 3, 4, almost 5 months and a 50% decline, that is not going to lead to big returns. That's going to lead to blowups and wasting a lot of time with dead money. So I make note of this, right? Had news, great response. Now it goes through the VCP and you get that nice pivot. This is where I want to be getting on board, right there, just as it takes off and on the launching pad. So again, here, look at the big demand here. This was workday. There's got a few examples here that are a little more recent. So again, 1, 2, 3, 4. Here's your tightenings, right? And everything's culminating to that buy point where it comes out and you get at a profit right away. But look at that big volume and that big move off the lows. That's that demand. That's what I want to see within the base. Sometimes you'll get it in a number of areas. Okay, you'll see here it comes up here, and you got some you got some demand right here, right off the low. So you're getting support around these lows, but it's just not time yet, right? Yeah, it hasn't gone through those iterations. You haven't gone through those tightenings yet. But then when it finally tightens up here, you see if you just draw a line from that last tightening, that buy point, you could even move this down right here. That's actually fine right here. Whoops, sorry about that. Move that down right here. That's tight enough right there, just a couple days, and you can start buying right on that day. I think that's actually where we're supposed to be. And again, this was Garden Central CENT. If you draw a line from the pivot point, you see how almost all the price action is below that point where the pivot's setting up. The supply is way to the left, and it's only traded above there for just a little while. So minimal supply, minimal trapped buyers now, and you've had all that time. Just to
point out, it's far left. This is where, to use David Ryan's rule, just draw a line for those of you guys starting. Keep it simple.
Right.
If you've got a lot of stuff above that line in the past week or 2 or 3, it's probably not ready. But, if you see some, this is going back now, 6, 8 months, but even then there's a very little bit. So the minute you trade above that, you're clearing all of that far back to the left out.
Yep. Same thing here. When you look at Cenacorp, again, see the demand right here. You've got some strong demand here, but it's not ready yet. You haven't put in that time and tightened up on that right side. Well, where do you want to be in the stock? You want to be in the stock over here and waste all this time, or you want to be in the stock right here? And within a number of days, you're up huge on the stock.
This is a good example. This is a good example too, Mark, of where patience pays off. And I remember this name well. I traded this one because if you look at a few of those other areas where it tried to break out, if you bought those, you got rinsed out. To Mark's point, less disciplined traders were laying the groundwork. And I guarantee by the time it sets up properly, a lot of them were gone because they'd already been rinsed out of the stock a few times. And sure enough, it tightens up there on the right-hand side and then just wham, comes out huge.
Going back to what Mark said earlier, you want to be the last weak hand. That's another golden nugget, another $1 million sentence. Again, so here's Green Plains. So come right up, you get some demand here right off the lows. Very quickly off the lows, you move right up near the highs. But now you need to tighten up a bit here, right? You look at, here's a weekly. I'm just going to move forward a little bit quickly. Kenneth Cole, KCP, this was a stock that I bought. I bought it right over, actually right here as it was breaking out. I bought it right there. But again, you see the nice demand you have here coming off up the right side here. You got some real strong demand here. They had really strong earnings, sales. And again, you can see the market. This is the S&P. The S&P had already been moving here. So this was actually lagging the S&P, but setting up a nice big base. But you're in a bull market here. So I'm going to move on here. Let's see. And actually, we're going to take a break now. We're going to take a break. There's a couple more examples here you could look at, but I'm giving you a lot of precedents and a lot of charts here. So you have these examples for you to compare and to learn and to burn into your retina, burn into your brain. So when you look at these charts, you're looking for this. It's not important that they're exact. What's important is that you understand the concept and you start looking for volatility contraction. Over time, you'll get this, you'll develop skill. You'll develop the skill to identify these. You'll be able to know what aces and kings look like compared to a pair of threes, or king three offsuit. You'll to use a poker analogy, you'll start to be able to identify those, and you'll see what constructive price action looks like versus price action that's more dangerous and risky and volatile. So we're going to take a break, and then we'll come back. When we come back, we're going to talk about what you look for after the stock comes out of these bases, goes through the pivot point, and whether you should hold it for a longer period of time, or if something's wrong and you should be looking to reduce or sell the stock, looking for what I call confirmations and violations. When we come back, we're going to take a break right now, though. Okay. See you guys in a little bit.
Okay, guys, sorry about the interruption, but it was just a minor thing. We do have technical glitches that do occur from time to time that unfortunately did happen with Zoom. But this is going to be a 15-minute break that we'll be taking. I hope you really enjoyed that section. It is really getting into the details that makes this real fun and exciting for the workshop, for me at least. And when we come back, we'll be picking up on natural reactions. So let's take a 15-minute break now. Get up, get some food or jumping jacks or push-ups, and get the blood pumping. Speak to you in a few.